Meta just reported earnings and it was an absolute blast. They beat on revenue, they beat on earnings. Their guidance was adjusted on the upside, meaning what they told they were going to do for future revenue more than 12 months ago, they actually increased that number by a large margin. But the stock itself is down over 17%, which makes you think, did Wall Street lose their minds? So in this video, we're going to figure that part out. We're going to see what the thesis was for this pullback, and we're going to take a look at the fundamentals of the business and see, is this an investment that we should jump into? Number one, let's start with the stock price. It's at $621, all the way down from almost 750. So this consolidation wasn't small, it was massive. Now, when we take a look at revenue history, current revenue for the last 12 months was almost $190 billion. Again, spectacular. And if you take a look at its growth, it's been growing on average for the last 5 years above 20%. Now, they've had years where they had no growth, and they had years where they've slightly missed on that 20%, but that's always been met with exponential growth either before that pullback or after that pullback. So the average, 20% for the last 5 years, which, let me just say this, if you would have told someone that this company that is making almost $70 billion a quarter is going to grow above 20% for the next 5 years, they would have called you crazy. But that's what they did. Next, we're going to take a look at the number of outstanding shares. Is this going in the negative direction? Meaning, are they printing more shares, diluting the shareholder? Or are they going in the positive direction where they're buying back shares? As you can see, they are buying back shares. What I really like about this company is they have intelligent investment mindset, meaning when the company becomes way too cheap to ignore, they aggressively start buying back shares. When the company hit $90, they were buying almost 5% of the company back at an aggressive rate with debt. I love seeing that. But the amount of money they spend buying back shares has decreased because the number of shares have also decreased, but the stock price is higher than it was before. So now they're spending 40 billions buying back buying back shares, but the amount of shares they can buy back is way less because it's no longer a stock price of $90 that it used to be. So I like seeing the consistency in the dollar amount. However, a little bit of concern is that I don't think they can keep up this pace of 1% every year. I think that will go down as well because the stock price, as it goes up, they might do less buybacks and reinvest that money into research and development, which I also appreciate and like. Next, we're going to take a look at margin of profit. The margin of profit is above 30%. This is extremely common for software companies that don't have to do massive reinvestments on hardware. This number I've seen with Google, I've seen with Amazon on their advertisement platform, and most recently I'm starting to see these type of numbers on Netflix on the advertisement front for their advertisement tier. So 30% is actually reasonable. Now 30% in terms of the entire industry is extremely high. The tech sector average is anywhere from 15 to 20%, but the software side is actually very reasonable because software companies with this type of business model, they usually have anywhere from 25 to 35%. So Meta is actually in the dead center, which I like to see. Next thing we're going to do is we're going to see what the projected revenue is from analysts and what the LLMs, particularly ChatGPT, Gemini, Claude, and DeepSeek can analyze the revenue to be by 2030 based off of historical trends, sentiment, and market saturation. When we ask ChatGPT, it gives us an analyst projection of 268 billion by 2027 for analyst projections. And then it says based off of historical trends and a few other factors, it's saying we can get to 361 billion. In my opinion, if I'm going for a conservative point of view, I would make that number slightly less. When we ask Gemini, it says 300 billion. I think this number is way too low. With ChatGPT, I thought it was too high. With Gemini, I think it's a bit too low. So let's see what Claude thinks. Claude says 400 billion by 2030. Very high. I don't like that number. So to me, that's an outlier. I'm not even going to put this into my thesis when I do my calculation on a base case. DeepSeek says 317 billion, a bit too low. Looking at these factors, I'm going to say about 350 billion for the base case for this company for the future. Now, I want to touch upon what is causing a consolidation outside of the fact that this company is spending a lot of money on capex for research, development, and data center build out. In 2022, in 2025, Q2, it had a net profit of $18 billion, above 18, which made analysts go crazy. They were buying this like it was the last living thing on earth. Now, this year, because of the Trump administration, they did some revaluation based off of Facebook's history, meaning when Facebook went public to now, they said, hey, you owe us an additional 16 billion. So now their tax expense was over 18 billion, which means they only had a net profit of 2.7 billion. Can you imagine being in a position where the government comes after you for everything you've done until the point you started off as a company, and for you to just pay them off in 1 quarter? Just 1 quarter. All it took them was just to say, all right, we owe you this much in bad taxes since we went IPO'd. And they're like, yes. They're like, all right, here's our 1 quarter profit. And not even the whole thing. They still managed to keep almost 10% of the profit from the quarter. That made me realize how special this company really was and why I should invest in it. Now, let's go ahead and take a look at CommonInvestor Dana and see what we get for a stock price. Before this video started, I went ahead and plugged on all those numbers for current metrics. I put in the revenue, the number of outstanding shares, the current PE, the current profit margin, and its stock price, which is at 621. Now, for future projections, like I said, I am going for 350 billion on a base case. Then I am going for a 3% decline in number of outstanding shares. It looks like it can do 5. Very honest, it looks like it can do 5. I think its revenue and profits are going to increase, and the data center expense is going to pretty much become zero after 2027. So I think from 2028 to 2030, you're going to see aggressive buybacks from Meta. But I want to stay conservative and not put too much of thesis into this. So I'm going with a measly 3% buyback over the next 5 years. And for profit margin, I'm going with 30. And for PE, I'm going with 30. If this company can pull off 350 billion, trust me, people are going to want to buy in, which is going to drive up the multiples. So 30 is actually very reasonable. And then we get a stock price of $1,262.61. Now, this was the thesis that made me very interested in the stock. This is the reason why I actually have $1,200 in the stock right now. Now to me, what's crazy is that I am actually beating the S&P above 2x. So if I invested that same money into the S&P 500, I would get an average return of 10% a year, which would mean I would get $900 over the next 5 years. With this company, not only is it cheaper than the S&P 500, but the potential for a higher return is almost guaranteed because we're just doing this on a conservative basis. So already on a conservative basis, I'm getting a 2x. What if it can hit this bull case? And this is the reason why I will continue to buy this stock as it keeps dipping, and I will have a $5,000 position once all of this is over. So if it can continue to do what it's doing right now today, which is growing 20% a year every year for the next 5 years. So CommonInvestor Dana has this beautiful feature which is called compound cake. This lets you project how much a company can compound every year. We're going to say 20%, like it's been doing for the last 5 years. Why would you expect this to be any different, right? So if we just use past metrics as an indicator for future metrics, we get a stock price of $1,700. Now we have a bull case of 3x, and we have a base case of 2x. There is no loss in this. Either way this company shifts, you're still going to make a profit. And in the worst case possible, you'll still get 20% return better than the S&P 500. I believe this is an absolute buy in my opinion, and I am buying. And I feel like if you want to plug this company at this price is a buying opportunity of a lifetime in my opinion. Now, if you want to find out where your thesis will take you, you can go to CommonInvestor.net and plug in some numbers for your thesis and see if it makes sense. You might disagree. Your thesis might say this company is not going above $800. Your thesis might say this company is not going above $800, but that's the beauty of this tool. It gives you a number behind your thesis, making it a concrete decision. Because a thesis without numbers, it's a guess, and we don't guess an investment. And the best site on the internet to do that is CommonInvestor.net. I hope you enjoyed this video. I hope you liked this video. Check out the website. Please like, please subscribe. It takes a long time to record these videos, so I do appreciate you guys watching them, and catch you guys in the next one. Peace.